All right. So the last two chapters, we've been talking about retail businesses, and um, and that brings us to this kind of third topic, which is not specific to retail, but very common to retail. A lot of times in service-based businesses, you bill people and then they pay you. Like they just send you, they used to send checks. Now they usually just pay with some sort of online, right, where they just put their card number in and they pay you. But in most retail businesses, you have a point of sale, like a cash register, right? Well, people pay in cash. And when people pay in cash, well, the potential for cash to go missing is real. Okay. Like employees steal, employees give the wrong change. Uh, you just cash goes missing. So you have to have something called cash control, or sometimes it'll be called internal control. And the goals are that we safeguard our assets, specifically our cash, and then that we have accurate information, that we're in compliance with any sort of laws or regulations. Okay. And so what we mean by control is simply that we have some way of knowing how much cash is supposed to come in and reconciling that much cash with what actually did come in, right? So I used to be on the board for our AYSO soccer league in this area. And our AYSO is good sized, about 900 kids playing soccer. So when 900 people all pay their $65 soccer fees, do the math, right? That's a lot of money, about $50,000 coming in. Some people, after a while, we were able to get them to register online, but people had been so used to coming in and paying with cash or check and so when I took over as the commissioner of the league, they had no internal control at all. So very easily, okay, let me just ask you, what's the most flexible of all assets? It's cash, right? You can use it for anything. You can buy whatever you want with cash. That's the great thing about cash. It's flexible. So if I have 300 people come register and they pay $65 a piece, that's about 300 times 65. What is that? 18, $18,000 or so in cash. If only one volunteer is collecting the money, how easy would it be for them to take $2,000 off of that and deposit $16,000 into our account, and no one would really know the difference? Pretty easy. So what do you think are some things we could put in place to minimize even the temptation of theft? And also, what's the possibility that somebody could have been putting money in the box and they pick up the box and it dumps? I mean, stuff like that happens. Good people sometimes accidentally, and then they collect up the cash and put it in there, and there's $500 that went under something. Or so what do you think? Okay. So a record, right, that we reconcile against, so we know exactly how many people registered, multiply that times the amount per registration, we know how much money should be there, and then we can compare that against how much is actually there. That's a good start. Anything else you would do if it was your money and you didn't want it was your, say, employees that were handling it instead of just anything? Anybody ever worked in a place where you have to handle cash, like a retail store or somewhere? What other rules do they have? Yes. Yes. Always at least two people. So all we did for the AYSO is we kept track of how many registrations, and then we also had two people there when we were collecting money. And at the end of the registration, the two people counted the money up together, saw that it matched up with the amount that should be there. Then they both filled out a little form that said we had this many registrations, this much money. They both signed it. and then turned that money over to the treasurer. The treasurer took that money, deposited it in the bank, and then took the bank deposit slip that had how much was deposited in the bank account and stapled it to the form. So now we had a form saying we had this many registrations, which means we should have had this much money. We counted it, we had this much money, and we stapled a receipt from the bank saying this much money was deposited into our account. That was a huge difference for a relatively small amount of effort, right? And so that's what we mean by internal control, like having a process rather than just like and to our knowledge, no one ever stole. Like all the people that are there are volunteers. They're very into what soccer does for the kids in the community. But it, to our knowledge, right? We don't know. So this lets us be sure. Okay. Then the other thing we had is that you never paid anything out in cash. Everything was paid by check, and all checks had to be signed by 2 members of the board, right? And we had a budget, and so the members of the board were allowed to spend the money up to the amount on the budget. But if they were going to spend over than the amount on the budget, then it had to go to a board meeting and be voted on, right? You couldn't just spend money. So that's what we're talking about with internal control, a means of making sure our cash matches up to our actual cash, the amounts it should be, and then safeguarding those assets. Maybe. All right. So I think we kind of covered these ideas. One thing we didn't talk about is something like separating responsibilities for related operations. If you ever work at like a Walmart, they'll give you, when you show up on your shift, you go to the accounting office, they've verified how much is in the drawer, you take the drawer up and you put it in your drawer, you work on that, then you take that drawer back to the accounting office, and so it's not you counting up how much you were supposed to bring in, it's someone else. So separating those responsibilities so that it's not the person who could benefit who's also doing the counting, right? And in the accounting office, there's always at least 2 people. All right. So this is something that it used to be everybody was familiar with, and now almost nobody's familiar with, and it's a bank statement. So back when I was a wee lad, we had these paper things that came in the mail, and it told you like how much was in your, some of you maybe still get bank statements, but most people, we do online banking. I don't get paper statements anymore. I can go click on statement and download it as a PDF if I want. But here's the features of it and why it matters from a control perspective, okay? Is it will have the dates that it covers. It will have the balance at the beginning of the period, all the deposits into the account, any withdrawals from the account, other debit or credit memos, which we'll see in a minute, and then finally a balance or a new balance at the end of the period, okay? So this helps us to have something to compare our actual cash against, okay? And well, not just our actual cash, but our records against the bank's records. Then there'll be all the detail, like it will list all the checks and other debits, and it will list all the deposits and other credits. Okay. So that's, we're going to have to learn how to do what's called reconciling a bank statement to our books. So remember, think of the process. When money comes in, we record that in our books. So if it's for sales, we would record a debit to cash and a credit to sales. And then we would also record a debit to cost of goods sold and a credit to inventory, right? Those 4 things. And so at the end of the day, we would take whatever cash we had and go through our process. Usually 2 people carry it down to the bank and drop it in the depository. And then usually not that night, but the next day, or if it's on a weekend, like the following Monday, the people will come into the bank, they'll count it all up, check it against our deposit slip, and process it, and it'll show up on our bank statement. So sometimes there's a day or 2 or 3 delay between what we recorded in our books and what shows up on our bank statement. Also, any money we collected through like credit card payments, that usually takes 24 to 48 hours to clear into our account because it goes to a clearinghouse, and the same with checks. Not very many people pay with checks anymore, but some, okay? So if you get a check and you deposit it in your account, your bank has to send an electronic memo to their bank. Their bank checks that they have enough money in their account. If they do, their bank transfers that money over to your account. That's the process. So there can be this little lag time of 3 to 4 days sometimes, depending if it's the end of the day or whatever, between what we see on our statement and what we have in our books or what we've recorded. Because when someone pays me, I record it that day, usually. All right. So here's what it looks like. This is a little weird, and this is why people who've worked in banking always get confused by accounting terms. But for me, the business, I'm the company. When I put money into my bank account, I'm doing a debit to the asset account cash, right? Some businesses might keep separate asset accounts for, like, their checking account and their savings account or whatever, but still we usually consider all of that cash because it's money you have immediate access to. So when I deposit money in my account, it's a debit to my cash, but to the bank, it's a liability. This is a little not commonsensical to me, at least. Why do you think money deposited in a bank account is a liability to the bank? Well, because you're lending it to them and they're not loaning it out to anybody yet. Gee, that's how banks make money, right? They pay you less than 1% of interest on your savings account. You can get high yield savings right now that are close to 4%, about 3.5%. So let's say I have a high yield savings, they pay me 3.5%, but then they turn around and loan that out to somebody to buy a car at 8%, right? So my money's not that much, but if you take everybody's money together, Bank of America or Chase, probably those are the two biggest retail banks in America, they each have like over $1 trillion in assets under management. So if they're earning 8% and only paying 3.5%, they've got a cushion of 4.5%. Does that make sense? A margin. What's 4.5% of $1 trillion? $45 billion, right? And to be honest, the savings accounts and the car loans aren't where the money's at. The credit cards, where they're charging 18% and still only paying 4% for the money or 3% for the money, that's where they're really making the money. And they're not just earning on that. Also, they take a big chunk of that money and they invest and they play the market with it. And if they can do better than that, like this year, my market investments have made me about 14.5% return. So pretty good if I'm only paying 3% on the money, right? So, all right. So whenever you deposit money in the bank, you're lending it to them. So to them, it's a liability. If it's a checking account or a savings account, you're lending it to the bank with the idea that you have access to take that money back whenever you want without any sort of notice on your part. You can also invest in the bank or lend money to the bank in what's called a CD or a certificate of deposit. And those usually have a term like 6 months or a year or even 5 years. And so then what you're saying to the bank is, hey, I'm going to put this money in and I'm not going to touch it for the next 5 years. So they know they have a little more flexibility in how they invest that money. Okay. Um, so that's how, so recognize just when we're doing a problem like this, if we're doing it from the bank's perspective, it's going to be different than if we're doing it from the company's perspective. So typically with a company, we're just dealing with our cash account. And if we deposit money, it'll be a debit to cash. And if we take money out, it'll be a credit to cash. For the bank, a deposit received from a customer is a debit to their liability. It'd probably be called something like customer deposits payable or something like that. Uh, and um, if we take money out of our bank account, it actually reduces the bank's liability. Okay, that's a little weird to get used to. All right. So in order for us to reconcile our bank account, meaning match up what we have on our records, our books, against what the bank has on their records, which is shown to us on our bank statement, we have to do two things. The first is we're going to take the cash balance according to the bank statement. So we're going to look at our statement and say, this is what the balance should be, or this is what the balance is on the bank statement. Then we're going to add any deposits that have not yet been recorded by the bank. And we call those deposits in transit, which means we've deposited them and recorded them in our books, but they're not yet showing up on the bank statement. Remember I said there's that 3 or 4 day lag time between when we put it in and when it shows up on the statement. And then we're also going to deduct any outstanding checks not paid by the bank. So any checks we've written or payments we've made that we have recorded in our books, but aren't yet showing up on the bank's records. And that will give us an adjusted balance. So what the bank says our cash balance should be, plus any deposits we've made but haven't yet shown up on the bank statement, minus any checks we've paid out but aren't yet showing on the bank statement, gives us our adjusted bank balance. So what we're really doing is saying we're going to take their balance and then add in the things we know are on their way to the bank, or deduct the things we know that are on their way to being paid out by the bank. That gives us the adjusted bank balance. Then we're going to take our cash balance according to our books. We're going to add any credit memos that had not been recorded. So when you get your bank statement, you'll see sometimes that money came into your account that you hadn't yet recorded. So now that you got the bank statement and see that it went into your account, you need to add that to your account. Okay. This happens a lot. Like when I sold my business, rather than them having to like send me a check in the mail, we worked out where they would make a payment to a company, and then that company would automatically deal with all the interest and all that stuff, and then they would just put the money into my account, like electronically. So each month, I would assume they were going to pay me, but I didn't know for sure till I got my bank statement, and it was like, yep, that money went in. Good, right? And maybe you had that, or when you do like, so that would be like a credit memo, meaning I look at my statement and I show there's a credit to, it's called a credit because it increases the bank's liability. It's actually an increase to my account, right? So it's a little confusing. So add any credit memos and then deduct any debit memos. Same thing if you have like bills on auto pay, you assume they're going to get paid, but you don't really usually record them into your book until you look at your statement and go, oh, yeah, those paid out, right? So we'll deduct any debit memos, and that will give us an adjusted balance to our books. And then those two should match. And if they match, we're all in balance, and we have reconciled our bank account to our books. Okay. So it's a little confusing until you do it a few times, just like everything else in this class. So in a minute, we'll go through an example one. So if you wanted to break it into steps, bank section of the reconciliation, we enter the cash balance according to the bank from the ending cash balance on the bank statement. We add any deposits not recorded by the bank. Sometimes you'll hear those called deposits in transit. Then we'll deduct any outstanding checks that have not been paid by the bank, and then determine our adjusted balance by taking the beginning, adding those, deducting those, and that will give us the adjusted balance. And then for the company section of the reconciliation, we'll enter our cash balance according to our ledger, what it says our cash balance is, add any credit memos from the bank, money we've received that didn't get recorded yet, deduct any debit memos, meaning money we've paid out but that hadn't been recorded yet, and make sure they're equal. There's another little thing in here that sometimes there's an error. Like either we made an error entering in our book, and then when we see the check cleared on the bank statement, we're like, oh, and we go back and check and we're like, oh, yeah, that was our error, and we have to fix that. Sometimes it's the opposite. Every once in a while, the bank makes an error. They run those checks through electronic scanning machines, and they're not perfect. And so in real life, you just have to like see, was it my mistake or the bank's mistake? And then we have to make an adjustment either to the bank balance or the book balance, depending on it. Okay. All right. So let's actually look at the guided assignment for Chapter 7, Part 1, and go through this process of doing a bank reconciliation. It's gonna be fun. I can see in your face, you guys are pretty fired up about it. All right. So, as you can imagine, everything I just explained, it becomes a big, beefy word problem. Beefy. When you say beefy, you got to drop your voice an octave. Beefy. Like that. All right. It just sounds better. Uh, would you rather have a beefy word problem or a beefy boyfriend? I know you want a beefy boyfriend. I could tell just by looking at you. All right. Um, he's like, that's not funny, bro. All right. Sorry. Shouldn't make jokes that are, you know, inappropriate. That's where I take a drink to calm myself down. Then we move forward. All right. So the cash account for Collegiate Sports Company on November 1st, 2019 indicated a balance of $81,145. During November, the total cash deposited was $293,150 and checks written totaled $307,360. I do this for the people who are listening to my recordings at double speed. That really freaks them out because it goes to like quadruple speed. Like, All right. The bank statement indicated a balance of $112,675 on November 30th. Comparing the bank statement, the canceled checks, and the accompanying memos. Comparing with the records reveal the following reconciling items. So in this one, they're not showing us the actual bank statement. They're just telling us all the reconciliation items that are on it. So checks outstanding, a deposit of that much, a check for this much incorrectly charged. So we're going to have an error to deal with. A check for $760 returned. Woof. Bank had collected for Collegiate Sports a note, bank service charges, a check for $2,500 that was returned to the bank because of insufficient funds. Okay. So there's so much information that the only way this works is to sort of just break it down step by step, piece by piece. You probably noticed that already with accounting, that if you get too global, it becomes really hard because there's like too much to deal with. So first thing, my cash balance according to my bank statement. So we're on the bank reconciliation and we're doing the bank section of it, not the books or the company records section of it. All right, so cash account for Collegiate Sport on November 1st was 81,000. During November, the total cash deposited was that. Checks written totaled that. Oh, there it is. The bank statement indicated a balance of 112,675 on November 30th. So that is going to be the bank statement's balance. Because if you look at this, this says as of November 30th. So they'll try to throw you off by giving you the beginning and the ending balance. It's always the ending balance, what it is at the end of the month. Okay. All right. So our bank statement says we have $112,675. And if you remember the steps I told you, step one is that we are going to add any outstanding checks, which means checks we've written. I'm sorry, we're gonna I take that back. We're gonna deduct outstanding checks. So we're gonna take away checks we've written, but that have not yet cleared our bank or are not yet showing up on the bank statement. So this section right here, where was it? Checks outstanding totaled $41,840. So we're gonna put deduct. Wait, maybe they do want us to, sorry. I, okay, I think they do want us to add a deposit in transit first. So a deposit of $12,200 representing the receipts of November 30th had been made too late to appear on the bank statement. So this is money that we know we've deposited, but it hasn't yet shown up on our bank statement. Then checks outstanding was 41,840. So we're going to deduct outstanding checks. Again, these are checks we've written, but haven't yet cleared the bank, meaning they're not showing on our statement, 41,840. And then here, this says a check for 7,250 had been incorrectly charged by the bank as 2750. So whenever the bank makes an error, we have to adjust that correctly. Okay. So we're going to deduct the bank error, charging the check as 2750 instead of 7250. And the amount we're going to deduct is the difference between those. Because we would have recorded 7250 on our account, but it came back as 2750 is what it showed up on the statement. So 7250 minus 2750 means a $4,500 difference. So our total deductions then are going to be 41,840 plus 4,500, or 46,340. And then find the adjusted balance. We'll just take 112,675, add the deposit in transit, subtract the deductions, and that will give us the adjusted balance. I got 78,535. If I'm doing this on homework, probably a nice place to use a check so that when I get done with the second part and I'm trying to make sure they balance, I know that this first one's correct, right? So that's the bank portion. Start with the bank's balance, add deposits in transit, deduct outstanding checks, and then add or deduct as necessary for any errors. I'll tell you, in real life, the bank making an error is fairly rare. They don't usually make errors, right? They have a vested interest in their systems working well. Like they want to have it correct. So they don't make a ton of errors, but it does happen. All right. So the second portion, the company record portion, is we take the cash balance according to the company's records. So this one, they're being tricksy, like tricksy little hobbitses, kind of. But this says on November 1st, we had a balance of 81,145, and then we recorded these deposits and these checks. So to get the balance at the end of the period, we're going to have to do 81,145 plus the deposits of 293,150 minus checks written of 307,360. So they were jerks and didn't just tell us what our book said. They said, oh, well, your books at the beginning of the month said this much. And then during the month, you recorded this many deposits and this many checks written. So I had to calculate my balance at the end of the month, which was 66,935. All right. We're going to add any credit memos, meaning things that showed money being deposited to our account on our bank statement, but that we didn't yet have on our records. Okay. So let's see what it tells us up here. looks like the bank had collected for collegiate sports $7,385 on a note left for collection. The face value of the note was $7,000. So this means $7,385 in cash came into our account. So I'm going to put add note collected by bank, including $385 in interest, 7,385. Then here we have a check for $760 was returned with the statement. So in the olden days, again, when they sent you your statement, they would send you all the checks that you deposited with like canceled stepped on them or deposited stamped on them or something like that. Now, again, they just scan them and you can pull it up on your electronic system with a scan. But so we had recorded $760 in our books. And then when the bank sends it back to us, it shows it as $7,600 deposited to our account from that check. And we go back and double check it. And sure enough, it was our error. When we recorded it, we recorded it as 760 instead of 7,600. That's what it's saying right there. So that means that we actually had, instead of $760 deposited to our account, I'll take 7,600 minus 760, and we should have an additional $6,840 going into our account than what we had recorded. Does that make sense? We recorded 760, but then found out it was actually 7,600. So we have to make an adjustment here. There should be 6,840 more dollars in our account than what we had recorded. And we're going to say add bank error charging check. No, add error in recording check as 7,600 instead of 760. Add those two together to get our total additions. 14,225. Now we'll look for deductions. This is a term you may not have heard. It's called insufficient funds. It says a check for $2,500 from Howland Academy was returned by the bank because of insufficient funds. What that means is someone wrote us a check to pay us. We deposit it in our account. When our bank reached out to their bank, they came back with, these guys don't have enough money for this check. So it bounces back to us and says insufficient funds, meaning you're not getting paid on this check, right? So when that happens, or sometimes you'll see them called NSF checks, which means non-sufficient funds. So when this happens, when someone pays us, we go ahead and record it. They paid us $2,500. Now we're being told, nope, you didn't get that $2,500. So we're going to have to deduct that check returned because of insufficient funds. And then also, here's a bank service charge for November of $125. So that's also going to be money that we didn't have recorded in our books, but now when we get our bank statement, we know they charged us $125. So we're going to deduct the bank service charges of $125. We'll add those up, gives us $26.25 in deductions. So now to find our adjusted balance, we just take the cash balance according to our records, add the additions, subtract the deductions, and that will give us the adjusted balance. So 66,935, whoops, plus, whoops, I'm making lots of errors. And I get 78,535. And so now I can see that my adjusted bank balance, which is my bank balance plus any deposits in transit, minus any outstanding checks, plus or minus any errors that we find, and my adjusted book balance, which is my book or my recorded amount that I have on my books, plus any additions that we found out about from the bank statement, plus or minus any errors we found out about, minus any deductions that we found out about in the bank statement, and then they all balance. So again, I'm going to use a check just to make sure I'm good. It looks like I am. Usually if those balances like balance with each other, then it means you did everything right. So yeah, as you can see, this can be a little confusing, especially the errors, because you have to talk yourself through, was this an error on my records or an error on the bank account? And it will tell you, but it tells you in word problem style, which makes it easy to get confused sometimes. Okay. All right. Now, one other thing we have to do is this first part, the bank statement. Remember, what we're adding to it is what's already on our records, but not on the bank statement yet. That's the outstanding checks and the um, and the deposits in transit. But on the second part, where it's us reconciling to the bank statement, any of these additions or subtractions weren't on our books yet. So we've got to do journal entries for them to enter them into our books. Okay. So, for example, the note collected by the bank, including $385 in interest, we didn't have that recorded in our books yet. That's why we had to adjust for it. So we're going to just do an entry here. It shows our cash going up. And then our, so if it was a note that was owed to us collected by the bank, we're going to show note receivable going down, cash going up. I'm trying to think about how this works. And interest revenue, right? So we got $7,385, 7,000 of which was a payment on a note receivable, and $385 of which was interest revenue. So when we get that bank statement, it says, hey, we collected $7,385, 7,000 of which was the note and $385 of which was the interest. We've got to enter that into our books with this journal entry. Oh, what did I do wrong? Am I missing something obvious here? Oh, I see what, so they're having us do all increases to cash in a single entry. So, so in addition to that 7385, we also had this error of 6840, which means we are going to credit the accounts payable of Ramirez for that 6840 as well. And then we're going to add all of those up to 14,225. So what we're saying now is, okay, this was not on my books before, but I collected 7,000 on a note receivable. I earned $385 in interest revenue, and this error where I recorded the check as 7,600 instead of 760 means I actually still owe these guys 6840 more, right? Because I recorded that I paid them 7,600, and then I found out I actually only paid them 760, which makes my cash go up because I didn't pay that money out. But anyway, so they're having us do all those together. And then we're also going to do all the deductions together. So this one's a little confusing. Our cash will go down, right? But non-sufficient funds is interesting because I had recorded that these people had paid me $2,500, and now I find out the money didn't come through. So what I'm going to do is I'm going to debit their accounts receivable, meaning they now owe me again, right? So the amount they owe me is going to go up because I would have credited that account when they paid me. And I had this bank service charge for 125. So we're just going to call that a miscellaneous expense. So we'll do 2,500, 125. And my total cash went down by 26.25. I know it's a little confusing right now because it's brand new. I promise you, once you work through it a few times, this chapter is usually not one of the hardest. It's not one of the hardest. It's people can work it out. So it just takes a little bit of practice with it. Last thing, if the balance sheet were prepared for Collegiate Sports Company on November 30th, what amount should be reported as cash? So after we've done these journal entries, then this amount should be right? 78,535. It's what we had in cash, plus now adding the notes that we collected and fixing the error and deducting the amount we had to pay for service charges and the non-sufficient funds. So this amount, our adjusted balance, should be the correct cash amount, 78,535. Yay, I've got 100%. Got 2 minutes left on class time. So that was, I don't know if some of you looked at it, were like, oh, there's only one question. This one will go quick today. No, it's kind of a long one. Anyway, so hopefully that's enough to give you a start. Remember, we don't have class tomorrow. I'll be up at Joseph City High School, the party town. They do have one restaurant in town and a gas station. That's it. Anyway, but and then we'll on Wednesday we'll do the second part of this guided assignment. Wouldn't hurt you to jump into the homework and see if you could look at bank reconciliation while it's still on your brain. But I'll leave it to you. All right. Have a great day.